Capital can actually take on a few different meanings. The meaning I'd like to talk about is the value of the owner equity or net worth that represents the amount of capital that the owner has invested in the business. This is good to know for a couple reasons. I think knowing how much you have invested is good just for common knowledge. It'll also help you know if you're making a profit or not, or if you're at least paying off what you have. And then also capital can be used as collateral to secure loans if you need an operating loan or a loan for either land or equipment. Next, I want to talk about micro and macroeconomics. Macroeconomics, this branch of economics focuses on the broad aggregate such as the growth of gross domestic product, the money supply, the stability of prices, and the level of employment. Microeconomics is a branch of economics that focuses on the economic actions of individuals or specific groups of individuals. I lump these two together because I think they're both good to know. It's good to know how they affect your business in both short and long term. For example, COVID had a macroeconomic effect on the entire world. However, like a drought in your area might just have a microeconomic effect. And knowing how those two things affect your business or your farm operation is very important. Next is opportunity cost. That's the cost of producing a good as measured by the amount of a second good that must be foregone to release just enough resources to produce an additional unit of the first good. I think realizing opportunity cost is important because your time is your most valuable resource, and it needs to be used efficiently and effectively. For example, if you're a small producer and you have a skill or a full-time job where you can make more money doing that and potentially just leasing out your land as opposed to farming it yourself, you could potentially make more money that way. Next is specialization. The separate and productive activities between persons or geographical areas in such a manner that one of these persons or regions is completely self-sufficient. When I look at specialization, I think of like a hobby farmer who might have multiple different types of animals, goats, sheep, chickens, cattle, and everything like that. But if they were to just focus on one of those things, they would be more efficient. They would maybe be able to produce more and potentially a better quality product. Next is equity, commonly referred to as net worth. It represents the owner's share of the business. This value is found by subtracting the total liabilities from the total assets. So equity is good to have an accurate snapshot of, so you know how much equity you have versus your liabilities, so you can gauge if your business is being successful. For example, if you're able to make the payments on all those things. Then next I'd like to talk about net farm income. Net farm income is your gross income minus farm expenses and taxes, and gross farm income, the annual level of income received from farming activities before farm expenses, taxes, and withdrawals have been deducted. So knowing both your net and gross income is very important. They go hand in hand, and it's letting you know essentially if you're making a profit or not and how much. Next, we have output index. This index shows the level of current production of output of a particular commodity or group of commodities relative to a particular year or base of period. It's good to track your output index so that you can compare years or time periods and know if you're staying at a level of output that's optimal for what you're doing as a business. It also lets you know if certain factors affect output and will help you make decision making in the future. And what I mean by that is if you had something that happened in a particular year that made your output more or less, then you can account for that. So say, back to the drought example, if you had a drought in previous years, you can adjust if you know you're going to have a drought the next year, or they're predicting a drought, then you know how you can adjust your operation, hopefully, if you've been keeping those records. Profitability. Returns on capital invested in farm assets represent a measure of profitability. May be expressed in dollar terms or percentage. Obviously, profit is pretty much your bottom line. The reason most people do business is to get a profit. So if you're not profitable and you're not tracking that properly, you're either working for free or you're paying to have your farm. Next is the law of diminishing marginal utility. A successive unit of variable input are added to the production process with other inputs held constant. The marginal physical product eventually decreases. So knowing how to balance the input and make your product with the marginal physical product decreasing is what makes the optimal amount of net income in your production. Cardinal measure, a measure that attempts to quantify the amount of satisfaction obtained from a consumer. I think every operator should have some metric to try to gauge satisfaction of their customers so they can make adjustments in their operation. An example of this is if you go to say you take some calves to the stockyard and somebody bought them the year prior and paid a decent price for them, and then you bring another set the next year or the next round and that same person doesn't even bid on them, there might be something that they were not satisfied with when they bought your calves the year prior. Marginal rate of substitution, the rate of exchange of pairs of consumption goods or services to leave utility or satisfaction unchanged, or the absolute value of the slope of an indifference curve. So knowing what your substitution options are when a price gets too high is good to know. For example, if you're feeding a certain feed and it gets to the point where you're not going to break even or make money if you keep feeding them that feed, knowing a substitution that you can give that has the same result that's cheaper would be a good example of that. Utility function is a mathematical or functional representation of the satisfaction of a customer derived from a consumable bundle. So your products, if if there's things that you can do to make your products more desirable, say you're selling cow-calf pairs for $3,000, and if they buy 10 of them, you'll sell them for $2,900 or $2,800 if you sell them as a bundle. That might make them more desirable. You'll be able to sell more off. It'll take less of your time to sell them in bigger lots, and that might potentially make you more profitable. Disposable income is personal income after payment of tax obligations. So disposable income, in my opinion, is what stimulates the economy. If you know when people have disposable income, you can take advantage of that. For example, if you have something to sell, like say in December, and you can afford to hold on to it until people get their tax returns back, they'll have some disposable income and you might be able to get more for that product. Change in demand, a shift in the demand curve generally caused by changes in the price of complements, substitutes, income, and taste preferences. So currently the demand for cattle is pretty high. People who anticipated this demand are benefiting from it now at the sale barn. Complements. Complements are goods typically consumed together, such as hamburgers and buns, goods for which cross-price elasticities are negative. So this goes well with changes in demand. If you know something that complements a high demand item, then you can capitalize on it. For example, when cattle are in high demand, so are steel prices like fencing, feeders, tractor implements, and things like that. So if you can find something that correlates with something that's in high demand and have the ability to sell it or make money on it, that would be a good example of that. Demand curve. Demand curve is a schedule that shows how many units for a good the consumer will purchase at different prices for that good during some specific time in a specified market, if all other factors stay constant. So knowing and understanding a demand curve helps helps you price your product. For example, the same example of selling the cow-calf pairs as a package deal. So normal goods. A normal good is goods for which consumption rises when income increases. So if you have a normal good and minimum wage just increased in your area, you can predict a higher volume of sales and potentially price accordingly for that. Next is ceteris paribus. It's the assumption that all other factors that might affect demand are held constant during that time period. So it's very hard to predict every change being made in the economy. If you're adjusting your operation based on one factor, just know that, in my opinion, just assuming that the rest will stay constant is assuming a risk. And so if you're just thinking about one factor changing and you're making decisions based on that, just know that there's other factors. You're just assuming that they remain constant, but they might not necessarily. Complements. Complements are goods typically consumed together, such as hamburgers and hamburger buns, goods for which cross-price elasticities are negative. During certain times of the year, items can be in more demand. If you're understanding and know that you produce something that complements other items, the demand will go up and you can adjust prices accordingly. And then there's cross-price elasticity. That is the measure of response of consumption and good for a service to change in the price of other goods or services. If it is defined as the percentage of the quantity of good A demanded by the percentage in change of the price of good B. When I think of this, I like to think of like services. So for example, if the price of lumber goes down and more people start building, then the demand for carpenters will be higher, and that could potentially lead to prices in carpenters going up. Next is substitutes. Goods A and B are substitutes if the cross-price elasticity of demand is positive. So being aware of substitutes for goods when the prices get too high can offset costs in your operation. Income elasticity, a measure of the relative response of demand to income changes. This is defined as the percentage change in the quantity demanded divided by the percent change in their income. I think this is a good way to measure whether your product is a luxury, a necessity, or an inferior good. When it comes to changes, when it comes to what changes what people buy, depending on how it changes how your product is viewed. For example, if you produce food, most likely that is a necessity. Or if you produce something whenever income goes down and you're having a hard time selling it, you have an inferior good. So that's just a good way to gauge the need for your product. And I think a good example of this, like on the services side, is whenever COVID did happen, and a lot of the places that were losing business were places that were not a necessity. Next is independent goods. Goods whose consumption is independent from the consumption of other goods. So this, I think the big takeaway is just understanding if your product is independent from certain things. So whenever you see like a spike in a certain market, know that it won't affect the product that you have, so you know you don't have to change anything. So for example, if you're producing, I had a good example for that, but I can't remember it now. So next is break even. Level of output at which average total cost equal average revenue. So obviously your break even point is very, very important to know. So if you know what your break even point is, then you know, and you have a good record of how much time and money and everything you have to make a specific product, then you know at what point you're making money and what point you're losing money. There's a guy down the road, he could tell you exactly what he has to sell each calf for to break even or potentially make a profit. So I think that's very important. Fixed cost. Specific form of current production costs that do not vary with the level of output or input of use. So fixed costs are typically easy to track. Most of people's fixed costs are loans, rent, lease payments. Even though they're easy to track, they're still very important because they're a liability and that subtracts from your gross income. So perfect competition is the market structure characterized by a large number of producers selling a homogeneous product, each with perfect information and no barriers to enter or exit. So personally, I think that if you're just getting started in a farm operation and you don't really own anything, I would say that we don't have perfect competition, only because of the fact that land prices have increased beyond the point where you can make money if you're doing cattle, and interest rates are really, really high right now. So I would say that's a barrier of entry if you're trying to get into any type of operation where you have to feed forage to animals. Average total cost. The total cost incurred by the business in the current period per unit of output. So I think keeping records of your average total cost, again, is a very good way to make decisions based on things that have happened in the past. Profit is your total revenue minus your expenses. In my opinion, small farmers are really bad at record keeping, and they really don't have an idea how much profit they're making, if any. So obviously profit means you're above your break-even point. And I think that we need to do better as small farmers in making sure that we have the ability to sustain things that do happen in the economy. And we have to at least break even. If we do make a profit, be able to save that back for years that we don't. Next is economies of scale. In production, are said to exist if the cost per unit of output declines as the level of production increases. So the good example of this, it takes just as much time to feed one cow as it does 10. So if you have room for 10 cows, then if you're just going out there and feeding one, you're not really being as efficient as you can. So you can scale up and make more money with the same amount of time. And it costs, feed per cow would be the same. So the unit of output would be less, and your production level would increase. So long range average cost curve, also known as the long run planning curve, is comprised of points on a series of short run average cost curve illustrating profitability for different size operations. And I think this also goes back to more of a record keeping thing and decision making, understanding the size of your operation and how profitable it is or could be. Next is marginal rate of technical substitution. The rate of substitution or trade-off between two inputs in a production of a specific product also represents the slope of an isoquant curve. So if you're keeping track, when you make substitutions, like the example I used for feed, let's say your cows didn't grow as big on the different feed that you substitute, and you actually lost money if you were to just buy the original feed at a higher price, and the rate of gain would have been better. So I think that's one good example of a marginal rate of technical substitution. Rental rate of capital. The cost of capital, broadly defined, the price you would have paid to rent all the inputs used to produce a business product. I think this is really important, especially for smaller producers. I was sitting in a seminar one time and they say if you don't put 1,000 hours on your tractor, that you actually should, it doesn't justify buying one, and maybe you should consider renting. And so I think it's good to know how much you use something, or for example, the land thing. If it's too expensive to buy land and interest rates are too high, but you can still lease land and operate. So just comparing the rental versus the owning. Production possibilities frontier reflects the physical trade-off in production between two products. The firm is said to be technically efficient at all combinations of two products along this curve. So I think an example of this is, say you're raising so many cows, and then you can raise more sheep or goats. However, the smaller the animal, the more labor, right? So cows, you can have less and they're less labor, but sheep or goats, you could have more and raise more, but they're more labor. And so you would have to sit down and figure out how much more time it would take to raise those animals, or a combination of those animals, and see if the outcome or how much you made would be more or less if you were to change or adjust your pasture and rotate to accommodate different things. So you would have to do those numbers and see if it would be worth the time and effort to do something else, and if you're making the same amount of money as if you were to just raise cows. Next is barriers to entry. Those forces that make it difficult for firms to enter an industry. Again, I think the biggest thing, the barrier to entry for agriculture, is land prices and interest rates, and hopefully they go down so that can still create perfect competition when it comes to the ag industry. Collusion is a situation designed to increase or maintain profits through price fixing and to restrict entry of new firms in an industry. I think it's really just important to understand that things like that go on, and they're hard to predict, and all small operators should have, hopefully saved for those rainy days if somebody is fixing a price, making it higher or lower, to adjust things like that. And hopefully the small business could potentially ride out something like that and stay in business. So imperfect competition is market structure when one or more of the characteristics of perfect competition are not present. And I'll use the same scenario again. I think that, in my opinion, there are barriers to entry in agriculture, and I believe how we don't really notice the impact now. If our industry doesn't change, it'll be very difficult for people who don't inherit farms and inherit capital to be able to get into farming. Agricultural Bargaining Association. These are formed by producers to improve the degree of competition in markets for agricultural commodities. I really just think it's good to know that there are associations out there like this that are working to keep a competitive ag market, and I'm hoping it will help protect smaller producers. Next is store of value, value of holding money as an asset. And I think this can be important because cash is very liquid. So if you keep a certain amount of cash on hand or even in the bank, you have the ability to use it very quickly. Like if you have an opportunity to, say, buy something at a very low cost, like land or maybe cattle or anything like that, and you can get a really good deal for it. But if you have it tied up in some sort of investment, like say you have a rental property or you own some land that you're really not using, to be able to get that money liquid, you'd have to sell that product for you to be able to use it. And so the next four terms, I'm going to go ahead and read them and then read the definition, but my justification for all four terms is pretty much the same. And that's the federal budget deficit, and this reflects the extent to which annual and federal government expenditures exceed federal revenue, meaning that they are already budgeting to spend more than what they're bringing in. The national debt is the sum of outstanding federal government securities and other claims on the federal government. Required reserves is the minimum amount of deposits that banks and other depository institutions must hold in reserve. So the amount that they can't loan out. And then there's indirect crowding out. And this occurs when the U.S. Treasury sells new government bonds to financial federal budget deficits, which lead to higher interest rates in money markets and scheduled private investment expenditures. So in my opinion, all four of these things are really good to just have common knowledge of how our federal government financial state is and how some of our financial systems work, because our nation is a huge impact on both micro and macroeconomics, especially in the ag world. And knowing those things and seeing trends in those things can definitely help you plan and make decisions for your future farm operation.